And good evening, everyone. Time for another silver update. A lot of price action in silver. For those of you that were following overnight last night, we got a good move in the Asian markets. We nearly hit 42, came very, very close to 42. And we got a pretty good sell-off today. So a lot of people are panicking, getting upset, and I just want to remind people, first of all, that the first time we've penetrated the $40 price in the last 31 years was on the 7th. So it's only 2 trading days after that that we're correcting back to 40. So it's not a real reason to panic. It's just a reason to watch and see what's going to happen, see if we get a good buy point. I've drawn a few trend lines here. Our most recent higher rising trend line we did penetrate today. Not a big surprise. Pretty unsustainable rise, but it may turn around and go higher. Now, our next trend line gives us a price point of roughly 39 to correct back to, and we have a couple of support lines I've drawn. We've got about 39.75 is the support line of this last break, and you can see we just touched it and came back up. So we have to wait and see if we're going to turn down and test it again. We haven't had a significant downside move, so a lot of you haven't seen it on the charts. If this is one of those, we get brief rallies and then huge penetration to the downside. So the way that shows itself in the MACD is normally you get, and I don't have too many here on this chart. I'll show you some in the further out chart. You have one close here, which is a fake break. In other words, you start to round up, you get near the line, and then you break down again. So you can see what the price did there. Looked like we were going to break out to the upside, but we failed, and then eventually we did break out to the upside. So is this going to be one of those? I don't know. You can see I've drawn a support line for the MACD itself down around negative 0.4. It's a MACD oversold point we hit around the 14th, 15th of February. So this oversold point that we're at right now is actually a very positive sign, because you can see in just the overnight and the fall today, we've burned off almost an entire month of overbought or bought condition. So this is essentially just one day and it's all gone. And we are looking at just 1, 2, and 3 points that are more oversold than we are right now, and we're at 40. So very, very bullish type of situation. Of course, a lot of the new people are getting panicky. I guess I'm not really sure when they bought, because to tell you the truth, I think we closed Friday at about 40.80. We rallied overnight and then went down. We're about 40.16. So I think the highest price you could have bought at while the markets were trending was about 40.80. So you're down about 60 cents. So not really sure why people are panicking at this, because it's just a pretty normal market move. But I wanted to look at an article that is on Zero Hedge today, and he, of course, addresses the drop in silver. And I wanted to look at what this is attributed to and further explore some of these option trades. So let me read this article real quick. Tyler writes, with everyone transfixed by the relentless move higher in silver, stories, myths, and virtually anything that is used a catalyst to explain any move lower in the precious metal. While earlier there already were two rumors that the COMEX would imminently hike gold and silver margins again, so far untrue. What is true, and what many are attributing the move in silver to, is what, according to some, is an outsized option bet that SLV will drop 37% by July. Bloomberg reports, quote, so this is from Bloomberg, a trader's almost $1 million bet that an exchange-traded fund tracking silver will plunge 37% by July was today's biggest single options trade in U.S. exchanges, as futures on the metal reached a 31-year high. The 100,000 options to buy 100 shares each of iShares Silver Trust SLV at $25 by July changed hands at the ask price of about 10 cents and exceeded the open interest of 6,000 outstanding contracts before today, indicating that a buyer of a new bearish position initiated the transaction. The ETF rose to the highest intraday level since trading began 5 years ago, 33 before erasing gains. It fell 0.5% to 39.67 at 12:54 p.m. It has closed below $25 since November. That's very confusing. We'll continue reading. I'll explain it in a bit more. Quote, it's definitely a massive downside bet on silver, said Henry Schwartz, president of Trade Alert LLC, a New York-based provider of options market data and analytics. It's so far out of the money that the buyer is probably just looking for a moderate pullback, because a $3 retracement to where it was in March could double the position to $2 million. Silver for May delivery in New York climbed as much as 3.4% to $41,975 an ounce, the highest level since January 1980 when futures reached $50.35. It last traded at $41.33. Silver, where half of global consumption is industrial, has been rising because it benefits from a rebounding global economy as well as demand for a haven, according to UBS AG. Interesting. UBS AG admits, you'll see here, silver's an inflation play and it's a deflation play. Interesting. Anyway, of course, such a simplistic analysis certainly ignores, this is Tyler again, such a simplistic analysis ignores what are likely numerous other components to a trade that is almost certainly multi-handed. After all, let's not forget, it was none other than Morgan Stanley on Friday explaining why there appears to be a sizable short gamma position in the market, which is substantially higher than just $1 million notional exposure, and which, if anything, is far more potent driver of the price of silver. Furthermore, if $1 million bet is sufficient bet to push the market in either direction, then it's safe to say that there's absolutely no liquidity in the PM market whatsoever. We're confident much more will emerge in the story of who is betting and what and how much on future silver moves before June 30th comes. Lastly, anybody out there heard of GASP hedging? So, of course, as Jesse Livermore's pointed out, whenever there's a substantial rise in a stock price or fall in a stock price, the public is always looking for explanations. So in this case, Tyler's providing an explanation. So I wanted to do a little gumshoe type investigation to show you how you want to interpret these stories and investigate for yourself to see whether they're true. So I'm just going to, I didn't open any windows or leave them open. I'm just going to show you how I would investigate this myself and exactly how we determine what actually happened versus what was reported to have happened. And so we'll look at that now. So we'll take SLV, that's our underlying, and we will go to Yahoo. We'll go to the SLV board. Okay, so when you go to SLV, you can see we're at 39.21, quite a bit below spot, which is a whole nother topic, but SLV is a suspicious entity. Most people agree on that. So we want to go to options. Now, options are reported based upon the months for the strike price. So I don't know if a lot of you know a lot about options, but options are an agreement to buy or sell a given security on a given date. So they have a strike price, it's right here, and they have a strike date right here. So the ones you're looking at right now, they're April 15th, 2011, and you have two groups. You have call options and you have put options. A call is a bet that the price will go higher by a given date, and a put is a bet that the price will go lower by a given date. Now, we're looking at the front month. What they mean when they say front month, that means the closest active month. So right now, that's April 15th. These close at April 15th. So you've got this Friday. You've got 4 days to be right. Now, they use the term in the money and out of the money, so we'll look at, they report the price here at the top. So $39.21 is the price for SLV currently trading. So at the money is a term that refers to the existing strike. So if we scroll down and look at our strikes here, $40 is the at the money call, and that's trading at 39 cents, 40 cents. The at the money put is right here, and it's trading at $1.19. Now, that's an interesting indicator in and of itself. The price of the at the money put is roughly 3 times the price of the at the money call. These should pretty much match each other. In other words, what is the odds that the price of this underlying is going to go up or down? Well, assuming a random market, which everyone knows there isn't, but just assuming no one really knows the future, then there's a 50% chance that tomorrow this price will go up, call, and there's a 50% chance this price will go down, put. But you can see that the puts are 3 times the price of the call. So be that as it may, that's an indicator of something strange right there. But we want to look at volume and we want to look at open interest. Now, open interest is the number of contracts. This price that you're looking at here, 7 or any of these prices, this is the price of the contract. The contract is for 100 shares. So each one contract, each single contract, or here is 20 contracts, is 100 shares per contract. So this represents 2,000 shares of the underlying. Now, the open interest is the number of contracts that exist, that are outstanding at any given time. So when you go out and let's say you got a bright idea, you said, hey, you know what, I've got a lot of physical silver and I honestly believe that silver's going down, it's going to correct, so I'm going to go ahead and take my brokerage account, use that to hedge my physical position. I'm going to buy some April 40 puts because I think between now and Friday, price of silver is going to go down. Well, you can see they went up 37 cents today from, well, they're at $1.19, so subtract it, do the math, but somebody made a gain of, and we'll show you how you can figure that out. If you just click on this link, this is that particular option. So today, this option made a 45% gain on the day. So a bunch of people bet that silver is going to decline by Friday. Now, to do a comparison for what we're looking at on this article, we need to do a comparison of volume and open interest. Remember, open interest is the number of contracts that exist on a given date. Volume is the number of contracts that have traded on a given date. When you go out and decide you're going to hedge your silver, and I'm going to buy an April 40 put because I think between now and Friday the price of silver is going to go below 40 and it's going to drop. I'm going to try to make a little bit of money to hedge it and buy some more physical, so I'm going to buy one of these puts. That every one you buy is reported in this volume. When you go to buy that, for every call or put, there exists an opposite transaction. So when you go and bet against SLV by initiating this option contract, someone took the other side. So when you buy a 40, someone sold you that 40. Normally that's a broker on the floor who's taking the other side. He might hedge himself. I can't even go into the ways you can hedge the other side, but he might do other months, he might do the physical, he could do any number of things, but he's going to sell you this at this price and you're going to buy it. When you do that, when you buy that put option at 40, the open interest increases by 1. That means a new contract has come into existence because you initiated a buy order of a put, someone sold it to you, and this number incremented by 1. So the outstanding open interest of these options is the total number of them that exist, and the volume is the number that traded that day. So the anomalies you want to look for are interesting situations where the volume exceeds the open interest. Okay, so look at 39, look at 40. These are the puts. Okay, so we have a volume today of 39,000 on the 39 put for April, this Friday. We have a volume of 30,000 on the 40 put, but the open interest is 12,000 and 9,000. Now what does that tell you? What it tells you is that most of this volume was the extinguishing of these contracts. So somebody who initiated this a long time ago covered it today, and this number decreased because remember I told you when you buy a put, this number goes up by 1. When you turn around and sell that same put, this number goes down by 1. So when you see this volume much higher on the daily volume than it is on the existing open interest, you know a lot of extinguishment activity went on for that contract. So remember I told you that we have multiple months that exist for these options. We have April nearby, May, we have July, and we have some leaps here all the way out to the 12 and 13. So we want to look at the one that Tyler pointed to. If you remember, it was the 25 put. Okay, here we go. So what Tyler Durden was referring to is this extreme move of 100,000 put contracts for the 25 SLV. Now, the first thing that's going to jump out at you is that, yes, there was 100,000 traded, but wait a minute, the open interest is only 6,000. Did they sell them? Did they buy them and sell them, buy them and sell them, buy them? What happened? So I'm not completely convinced yet, and I'm not sure about these reporting statistics. If some of you know if the OI is from yesterday and this volume, you want to check the open interest tomorrow on this 25 July SLV put and see what this number is. If these were initiated puts, this number should be over 100,000 tomorrow. I don't think it will be. I think this is, and some of the things that Tyler talked about indicate it's not. So this number may represent a lot of churning. I don't know. So I wanted to go specifically to this option. Now, you have this link here. This name is the name of the option. You can see the naming convention, SLV 110716 P0025. So this is this specific option. Now, when you go in here, you can see the July 2011 25 put actually increased 100% today. So, and it should have the high-low. It has a days range. What's really bothersome is it doesn't have the contract range. So we're going to have to look somewhere else to see that. But today's range is around 9 cents to 17 cents. So roughly a double. So somebody who bought this put at the very low and sold it, well, they haven't sold it yet. We don't know. But they doubled their money on the drop. If they grabbed that top and sold that drop, they could double their money. And here we have our 103,000 volume, very, very high. So what we want to do is grab this name. This is the name of that specific option. Let's do a search. And a lot of these come up with Yahoo. So let's go to an advanced search. And we want to label Yahoo as the unwanted word because we're trying to get a chart. So it turns out CBS Market Watch also tracks these options. So we'll click here and we actually get a chart. So let's back this chart out. This is a 5-day chart, and you can see this morning this thing opened around 8 cents, and with the sell-off in silver it rallied to 16 cents. Now, what are the odds that silver is going to go to $25? Actually, it doesn't have to just go to 25. It has to go below 25 to get in the money. But what are the odds it's going to go to 25 by next July? I think ridiculous. But anyway, the chance that it will do that has become 100% more likely, according to the option market, between the opening today and the close of today. So let's pull this thing out. Let's pick a 3-month, and that's not far enough, so let's go 6-month. So when you see this flat line here, that option didn't exist. It came into existence roughly around here. So for its life, this option has, the highest it's been worth is about $2.25. Now you can see it took a big fall, and a lot of this you have to understand with options is time decay. Because an option, as it has a certain expiration date, all things staying the same, for example, if the price of the underlying stayed the same day after day after day, the value of the option would fall and fall and fall, because it has a death date that it goes out of existence. So if you're not moving towards its strike price, you're losing value. So you can see this put, as silver was either rallying or going sideways, it was losing value. Then apparently somewhere around in January we had a big drop, and then silver continued its rise, and you can see the value of this put drop and drop all the way down to 0. So today somebody did a transaction for 8-cent SLV options. So it was 8 cents. Now you have to take that times 100. So a 1-priced option is $100. An 8-cent option is $80. So these options were $80, and they bought 100,000 of them. So they spent, is that 8 million? I think I did that wrong, so let's do that again. It was $8 It should be 800,000. So Tyler reported it was $1 million trade. It was about $800,000. So someone spent $800,000 today, and they doubled their money. So somebody bought this option at 8 cents, and it's now at 16 cents. They made $1 million bet, and they doubled their money, betting that the price of silver will be 25 by next July. So let's go back to the original article. I really like Tyler Durden. I don't want to diss him or anything, but when we look at the open interest, when we look at the amount of money involved, $1 million, I mean, really, who cares? So somebody made a big bet that silver is going to be, I don't know, would you spend $1 million to bet that silver is going to be below 25 by July? Looks like a bad bet to me. Has to go back to, actually below that support, so we're going to go farther back. Silver has to go back, and it has to be in the money. So at 8 cents, it has to go below 24.92. So silver needs to go to roughly here by July, what that date was, I think it was 16th. By mid-month next July, silver needs to be at this line for that guy to break even. Is it going to happen? It could. I don't think it's very likely. So I don't think that's what moved this market today. I think it's just a search for explanations, but I wanted to explain options, and I know I didn't explain everything. Options are very complicated. They have a lot of things, beta and spreads and straddles and butterflies and all that stuff, but I wanted to give an introduction to options and show you how the options can affect the underlining. And I don't think we're going to have this kind of correction this guy's predicting. What my lines are showing me is that we have a correction already started, and we're going to start rolling up. And this actually could be a good buy point. So for those of you who've been looking for a buy point, it might be here. You might want to pick up 30%, maybe 50% if you're trying to get into the physical, because it might just turn around right here and rocket all the way through 50. So we'll talk to you next time.